Dollar cost averaging is a concept that is commonly used in the investment world. A lot of financial gurus do tell us to incorporate this when we are starting out and keep at it, and it is in the end supposed to be something that is very yielding to use, that we are going to be able to see a great return on investment if we stick at it and average in on all the investments that we take on. And that is a little bit not entirely sufficient for you to be able to get the most out of your bag. So in today's video, we're going to talk about how to pair that with market timing. This is something that I use when I'm investing in my own portfolio, and I wanted to share it with you guys. And if you find it valuable, then by all means find a way to incorporate it in your portfolio, because it is going to save you a lot of time, and most of all, it's going to save you money, because it does really help. Look at incorporating market timing while you do your dollar cost averaging. So let's get into this video. Drop me a subscription. I think the word is subscribe. Forget it. Subscribe, like, and drop me some comments. Forgive my rambling. Many financial gurus tell us to buy and hold, and in the long run we will see result in a bunch of money being made in our portfolios. But this can be detrimental, especially if you're holding a very large position, because markets do not always go up. Sometimes they will go down, and this is the time when you need to be able to understand market timing. When it comes to market timing, you choose to buy at a particular price point and sell at a particular price point. But at the end of the day, you want to have these going hand in hand. But the thing is to be able to buy at a lighter dip and sell for when things are not going your way, after a strategic study and plan. You understand that this is not going to be yielding me anything in the near future or anytime soon. You got to be able to close it. But also, if it has given you your return on investment, you also equally have to be able to close it. So you're going to look at your investment, find somewhere where you're going to draw the line and find it as the hard stop, that where in case the investment doesn't go your way, you are going to be out of that position and move along into something else. This is a point you are determining at the start of your investment. It is something you have to calculate out and find a dollar value that you are willing to lose, or even you're going to be able to sleep at night without worrying if your investment is in jeopardy or not. So figure that out while you're entering in any position, and pay attention to it and honor your stop loss. Do not move it around until there's a perfect opportunity for you to move it. So the third thing would be to look at maintenance rules. When I talk about maintenance rules, when you are in any investment, like in a long-term investment, you are entering at the dips and you already have your stop loss. You want to look at adjusting it for whenever it makes new higher lows, especially when you are sticking to a high time frame, especially the weekly and the monthly. They do establish a great positioning for your stop loss adjustment. Every time it makes a new higher low, those are points at which I would put a stop loss. I would adjust it, thereby locking in the profits that I have made on that movement or to the upside. You can be able to use this month after month and move your stop loss accordingly, and you will be able to save a lot for when the markets out of the blue just turn around and take every profit that you have been able to accumulate out of the blue. Okay, so we're going to start off looking at the SPY. This is a chart of the S&P 500 stretched way back from 1993. By the way, I'm able to do this using the on-demand button in Thinkorswim. For those of you who know how to use it, it really helps for you to pull up data from before and also to be able to test out your strategies and also your plans when it comes to trading. Anyway, so for whoever started trading at around this time in 1993, you bought the S&P 500 at around $42, and things worked out pretty well for you. The market went up for a substantial amount. Let me see, 1, 2, 3, 4, 5 years straight. It was really going up for you. You were getting good returns on your investment. You're doing all of that. But the thing is, at a certain moment, it stopped going past that, past a particular level. And these are times when we want to be very careful for those people who sometimes start at a later time, and then they get caught up in such a trap whereby the market is not going past a particular level. When I talked about being in a sideways market, this is what I was meaning. So somebody who started at around this time in July of 1995, when you started investing at this point, in, if I could draw here a little box, if they started to invest around this time, in that year of 1995, they realized some profits, going forward. But then at one moment, price stopped going above and it started to come right back down. And look what happened. It reached up there to around 155.76. It came right back down. And the investment they had started with, all the profits they made on the way up, they lost them back down, in the process. And look what happened. It went further, afterwards it went up back. And then it went back down. So literally from between 1995 up to, I don't know when. Let's see if we can try to forward this chart and see when did it, later on, let's see, when did this sideways trend end, if it ever ended. So we'll forward 2 years ahead, like in 2012. 2012, did it update? I don't think I updated it. 2012, the 9th. Okay, reset. If I could reset it that way. We're still in that sideways trend, if you could see that. All right, let's forward a little bit more. We go to 2014. Maybe that's a bit aggressive, but what the hell? Let's just do it. All right, 2014, it did actually break out afterwards. It did break out, and finally somebody begins to see our return, more profits on the upside. But the point is, you don't want to be in an investment that is in a sideways mode. You want to be able to spot this and get out quick, and do something else. Or if you know how to take advantage of a sideways trending market, then kudos to you. You can always do that. And by employing the tactics that we're talking about, buying on the lighter dips like this and being able to have a stop loss that you are just every now and then, you are able to get out when the market begins to trend downwards, and also be able to get in when it reaches the bottom. That way you've already determined where the boundaries are, so you can always get ready for after it has gone up and it's coming down. What do? You literally know where the trend, the boundaries are, so you can wait down here and you're able to take advantage of it when it comes down back. These are some things you gotta be able to look into and be able to understand how to trade. So when such a thing happens, you know where to wait and put your orders, to be able to take advantage of the upward movement, and also to be able to close a position when it reaches the peaks of, our chart, as you have already been able to determine from the previous, markets, like right now. All right, so that's one aspect to look at. So when we talk about this having a stop loss, if I could clear out this chart, clear drawing set. All right, so let's take it that whatever happened, you decided to, let me take back the time to around maybe 2012, where we started from, and then I would show you exactly what I mean by having a stop loss set in place and working with it. So today, the current day is here, and we are looking at entering into a position at this point, price point. So this is typically where I would be buying into such a stock. I would be buying at this area, but this would be my buying price. I would enter my position here. I would buy here maybe 10 shares, and then I would have a stop loss right about there. Stop loss of 10 shares still. And then as time goes on, I'm going to mark this off with a little oval shaped ellipse here. Let me put it in a very nice color. Colors are attractive to look at. Okay, there. So if we entered entered this stock and decided to invest in it at that point in time, here's how we would go about with adjusting your stop loss and managing your position to be able to get the most back out of it, and also dollar cost average on the upside. So I've bought into it at that price, price point, which is 122.30, and then I have a stop loss. I'm taking on a risk between 122 to 107. That's about what? You do the math. I'm not going to do the math here because I'm bad at math. I would need a calc. Anyway, the thing is, you have a stop loss. So if we can forward in time, and then we go to 20. Okay, let me just go to the next year. We choose there. Look at that. So price has gone up. Meantime, you're averaging in. The next price point you would be is to adjust this. Come here. This is where I would be buying into for the next time. I would buy into this. I would add on my shares, which is the averaging we're talking about, the dollar cost averaging. I'll buy more shares, and at this time I would buy. Let me duplicate this, and then have a new stop loss adjusted. From here, I would move it upwards, and then if I move the time a little bit more to 2014. So if you could see, I'm looking at this on a high time frame, which is the monthly, because the monthly gives a very strong flow for price to be able to go through a month. Each candle here represents a month, so for it to go through it takes a whole month, and by that time I know you are having enough time to do other things, but also you can be able to catch it before it goes really so bad for you. It just literally doesn't just fall out of the sky, without you being able to track it. So sticking on the monthly when you're choosing your stop loss, and also your entry points when you're choosing to buy some more shares, is best to stay on a high time frame. Monthlies and weeklies are better. All right, so you have adjusted your entry prices here in case price ever comes back down, but you've also adjusted your stop loss. So what this is doing for you is it is locking in the profits that you made from the time you entered this position. From the time you entered this position, which was at the price point of 120, it was about 122 to some. Right now to 154, you've already locked in these profits. Nobody can, it's already actually back into your bank account, and you can use it to buy some more shares. So you see, This way you're leveraging in on an upward trending market, you know, but also you are locking in your profits, you know, you're locking in your profits, and you're not jeopardizing all your investment by not having a stop loss. So this is another point of entry that I would have used. Look at it, price came back here and it did bounce off. You could buy from here. This is a good entry point, and then you would still adjust your stop loss equivalently to match up for your entry prices above. So that's another stop loss. All these marked in purple are stop losses being adjusted, and they represent profits being locked in. Clearly, that this dotted line marks the profits that I am locking in over time. So you have to be able to protect your, you know, investment. This way you are not taken by chance when things do not work out or end up, you know, turning south over time, because that definitely does happen. The market doesn't always go up, so we need to be prepared for the times when it comes down. So after doing this, I will be adjusting and waiting. These are things I do throughout the month. I'm always looking out to see what is happening with my investment. I look at it, I adjust. If there is a stop loss that I need to adjust, I adjust it. If there is a new buying opportunity presenting itself, which is typically what we're talking about when it comes to market timing, if a new buying opportunity presents itself, I will mark it off and I will put a buy order there. So this is a new stop loss we would be using. Clearly there's a new one up here and there's a new one up here. That's every time it represents it presents itself, it also represents a stop loss below it, and that is still profits being locked in on the upside. So you want to pay close attention to that, and so on and so forth. All right, thank you. All right, I appreciate you sticking around. Next time we're going to talk about something very interesting, but the takeaway from this video is to be able to dollar cost average while you use market timing, but do not average into a falling stock. Find those that are having an upward movement, use a very hard stop loss, but also have some maintenance rules whereby you adjust your stop loss. Thank you very much. See you in the next video. Goodbye.